Hey folks, welcome back to the channel. Today, we're diving deep into a Singapore healthcare REIT that's been making the rounds, Parkway Life REIT. If you're watching this, chances are you're someone who wants both steady income and a bit of peace of mind, especially when markets get shaky. But recently, even the safest names have shown some cracks. So let's walk through what's happening together. If you've ever wondered, is this REIT still worth holding at today's price? Or are there red flags we should worry about? You're in the right place. We'll go through the 3 big positives, 3 notable warnings, and I'll give you my personal verdict with all the whys and hows tailored right to Singaporean investors. And just in case you're new, I'm Iggy, your friendly neighborhood Iguana. I've spent years breaking down investing in Singapore so you don't have to panic scroll when new results drop or policies shift. My goal? Make it simple, local, and practical. So first up, let's look at what Parkway Life REIT actually is and why people are buzzing about it again. This is Asia's biggest healthcare REIT, holding properties worth over $2.4 billion, think hospitals here, plus a fast-growing set of nursing homes in Japan and now France. Recently, their revenue jumped 8.1% for the first half of 2025, and that was mostly thanks to a new French deal that started bringing in cash. Now imagine a snapshot. Most of their money still comes from Singapore's 3 private hospitals. Japan is next. France, the new kid on the block, is just getting started. I wish I could show you the actual table here, but just picture a pie chart that's 2/3 Singapore, a quarter Japan, and a thin French slice. Long-term, steady leases cover almost everything. This isn't like a retail REIT that can lose tenants quickly. But here's the twist. Investors are paying a big premium for all that safety. In fact, if you looked at a table comparing Parkway's numbers, you'd see it trades at about 1.7x book value, a massive 70% premium, and yields about 3.5%, well below the market's more generous REITs. So why pay up for Parkway? A lot of folks think there's more growth still to come, but there's more risk on the horizon than before. Now let's get to the juicy bits. The 3 good. The first one is what I call Parkway's 20-year moat. These hospitals aren't going anywhere. Leases run all the way to 2042 and have a rare built-in escalator. Starting 2026, rent jumps by nearly 25%. Plus, the deals are structured, so rent goes up if inflation rises or the hospitals earn more. During the roughest COVID times, income stayed rock solid thanks to this structure. To me, that's like an insurance policy tucked inside your REIT. So, if you've ever thought, well, what if the economy tanks? This REIT's lease book is what lets you sleep at night. Next up, the second plus point, geographic diversification. It's not just Singapore. Late last year, Parkway spent over $100 million to buy 11 French nursing homes. These new assets are already pitching in almost 8% of income and have a healthy 6.5% yield. And in Japan, where almost 1 in 3 people is already over 65, those nursing homes are in long, stable leases too. Basically, Parkway isn't putting all its eggs in the Singapore hospital basket anymore. But why does that really matter for ordinary investors? Because Singapore's healthcare policy doesn't change overnight, but regulation and demand abroad give Parkway more ways to grow, spread risk, and maybe even boost returns over time. The third good point, the fortress balance sheet. Parkway's debts are low, only about 1/3 of its value, and almost all their loans are fixed rate. That means when rates shoot up, Parkway isn't sweating the way some other REIT managers are. Plus, they hedge their currency risks. If you're holding this for CPF or just steady dividends, those numbers matter. Oh, and no big debt coming due till late 2026. That's breathing space. Picture a trend table here. Revenue rising every half, DPU nudging up slowly, not exploding, just climbing, and debt levels flat. If you want an investment you can forget about on holiday, this kind of steady, predictable curve is what you look for. Now, by the way, if you want to see all these tables, the breakdowns, the checklists, and the written version, everything's on my Substack. You'll find the link in the description below. I put a lot into those write-ups, so check them out if you like charts as much as I do. Let's switch gears to the red flags, because even good REITs have issues. Red flag number 1. Concentration risk. About 65% of Parkway's value is tied to Singapore's 3 hospitals, and all are run by just one tenant, Parkway Hospital Singapore. If anything ever happened, financial hiccup, policy change, even a big drop in medical tourism, you're exposed. Put it this way, If your rental property had only one tenant, you'd worry, right? Same logic. The Malaysia exit also means there's now less backup diversification. France and Japan can help, but at just 6% and 28% of the pie, they're not yet enough to offset a wobble at home. Red flag number 2, high price, modest yield. Parkway is expensive. At 1x book value and a PE north of 25, it's at the very top for Singapore REITs. Yields are below CPF happy place levels. If you compare the top REITs, say First REIT pays nearly 9% yield but comes with major risks. Parkway looks safer, but you pay up for that. It's a quality, but don't expect fireworks situation. This is something I used to get confused about too. High price doesn't always mean future growth. Sometimes it means future returns are about as good as it gets. Red flag 3. The France adventure isn't without risks. The French nursing home sector got hit by scandals. Just Google Orpea or MS, and Parkway's management is still pretty new in this European playground. The leases are long and tenants stable for now, but if France changes rules or one of those operators stumbles, it could sting. Also, hedging all those euros isn't free forever. Currency moves can eat into what you get paid. Think of the risk checklist as a dashboard. Parkway scores well on debt and interest risk, but on tenant and geographic risk, the dials are flashing amber. Not red, but not green either. So, with all that, what would actually change my view? If Parkway adds new Singapore hospitals, especially if it can snag Novena Hospital, that would massively reduce risk. Or, if the France portfolio becomes more than just a small part of the pie and runs smoothly for a couple of years, that will help everyone relax. Conversely, if gearing shoots above 40% without boosting DPU or the Singapore hospital tenant shows any cracks, or worse, France stumbles, then it's time to get cautious. I'll be watching 2026 closely, as about 24% of Parkway's debt comes up for renewal then. Alright, here's my honest take as Iggy. For now, it's a hold, with a note of caution. If you already own it and care more about sleep than squeezing out maximum yield, there's no reason to rush for the exits. But don't be tempted to go all in just for the defensive label. The premium you pay today means returns tomorrow may be modest unless the whole portfolio can keep growing and diversifying. What I do, I keep Parkway Life at about 2 to 3% of my portfolio, using it as a pillar, not the whole house. If the price drops under Sfortis or the book value premium comes down, I'll add more. Until then, I watch, wait, and enjoy the steady rides, because sometimes that's what wins in the end. So, to wrap up, Parkway Life REIT is still a top-tier healthcare REIT, but don't ignore the warning signals, especially if all your REIT money is in one spot. Its yield lags, its valuation is punchy, and the France expansion is promising but not risk-free. If you're keen, time your entry below $4 and always keep an eye on concentration risk. What about you? Are you adding more exposure or looking at other sectors these days? Drop me a comment. Seriously, I love seeing what the community is tracking. Also, if you found this breakdown useful and want all the full tables, checklists, and my full premium research, consider joining the Investing Iguana community right here on YouTube. Just click join below. Not only does it help me keep making these deep dive analyses, but you also get early views. Catch you in the next one.